Welcome to Golden Rush, the podcast celebrating the incredible surge in precious metals. I'm your enthusiastic host, Alex. Before we dive into today's exciting analysis, I need to share an important disclaimer. This podcast is for informational and entertainment purposes only. It is not financial advice. For personalized financial guidance, please consult with a professional financial advisor. Now, let's celebrate these amazing gold and silver prices.
Hi everyone, I'm Sarah, your analytical co-host. Alex, what a time to be alive. Gold has absolutely skyrocketed to over $4,500 per ounce, and we're here to break down the mining companies that are absolutely crushing it in this golden environment.
Sarah, I can barely contain my excitement. We've done deep research on NYSE-listed gold mining stocks, and we've found some absolute gems. We looked at 3 key metrics: all-in sustaining costs, proven gold reserves, and debt-to-asset ratios. The results are spectacular.
Let's start with our absolute champion, Agnico Eagle Mines, trading under NYSE ticker AEM. This company is simply phenomenal. Their all-in sustaining cost is just $1,373 per ounce, which is $200 to $300 below their major competitors.
But wait, it gets better. Agnico Eagle has transformed from having $1.5 billion in net debt in 2024 to having $2.2 billion in net cash by Q3 2025. That's a complete 180-degree turnaround.
And their debt-to-equity ratio? A microscopic 1.4%. They're producing 3.4 million ounces annually, with 40 to 50 million ounces in proven and probable reserves. Plus, they operate exclusively in safe jurisdictions: Canada, Finland, and Mexico.
Their free cash flow in Q3 2025 alone was $1.18 billion. And here's something incredible. They've paid dividends every single year since 1983. That's consistency you can bank on.
Now, let's talk about the world's largest gold producer, Newmont Corporation, NYSE ticker NEM. While their all-in sustaining cost is higher at $1,566 per ounce, they make up for it with absolutely massive scale.
Massive is right. Newmont has 90 million ounces in proven and probable reserves. That's the largest in the entire world. They're producing 5.9 million ounces annually and generated a record $1.6 billion in free cash flow in Q3 2025.
Their debt position is nearly pristine, too. They have a debt-to-equity ratio of 30%, but their net debt is essentially zero at just $12 million. Moody's gives them an A3 rating with a stable outlook.
And get this, Newmont's reserves equal Barrick and Agnico Eagle combined. When you're operating at this scale with gold at $4,500 per ounce, every efficiency gain translates to enormous profits.
Speaking of Barrick, let's talk about Barrick Gold Corporation, NYSE ticker GOLD. They're sitting pretty with an all-in sustaining cost of $1,538 per ounce, and they actually have net cash of $323 million.
Impressive is right. Barrick has been absolutely crushing it with reserve replacement. They added 17.4 million ounces to their reserves in 2024. That's 23% growth before depletion. Their total proven and probable reserves stand at 64 million ounces.
What I love about Barrick is their forward-thinking approach. They have no major debt repayments until 2033, giving them incredible financial flexibility. They're producing about 4 million ounces annually and have diversified into copper assets, too.
Now let's talk about some honorable mentions that deserve serious attention. Harmony Gold, NYSE ticker HMY, has the most impressive debt metrics I've ever seen.
Their debt-to-assets ratio is just 3.1%. That's a 5-year low. Their debt-to-equity ratio is only 4.9%, and they're producing 1.4 to 1.5 million ounces annually, with all-in sustaining costs around $1,450 per ounce.
Now let's talk about Kinross Gold, NYSE ticker KGC. They've completely transformed their balance sheet by repaying $1 billion in debt during 2024-2025. They're now essentially debt-free with net cash of $485 million.
Let's put these incredible margins in perspective. The industry average all-in sustaining cost is between $1,600 and $1,680 per ounce. With gold trading over $4,500, companies like Agnico Eagle are making margins of over $3,000 per ounce.
That's absolutely mind-blowing. Every dollar these companies save below the industry average translates directly to their bottom line. When you're producing millions of ounces, that adds up to billions in extra profits.
The key takeaway here is that we're not just in a gold bull market. We're in an environment where the best managed mining companies are seeing explosive profit expansion. Companies with low costs, strong balance sheets, and significant reserves are perfectly positioned.
If I had to pick a golden trio for diversification, it would be 60% Agnico Eagle for their incredible cost structure and balance sheet, 30% Newmont for their massive scale and reserves, and 10% Harmony for their ultra-low debt exposure.
The mining sector is facing some cost inflation, about 6 to 7% in 2026. But when you're making $3,000 per ounce margins, that's easily manageable. These companies have never been in a stronger position.
What makes this even more exciting is the operational excellence we're seeing. Agnico Eagle has two mega projects, Malartic and Detour, each targeting 1 million ounces per year. That's going to be absolutely massive for their production profile.
And remember, these aren't just numbers on a spreadsheet. These are real companies with real operations, producing a real commodity that the world desperately wants. Central banks are buying gold at record levels, and industrial demand for silver continues to grow.
The combination of strong fundamentals, exceptional management teams, and the highest gold and silver prices we've seen in years creates an absolutely electric environment for these mining stocks.
As we wrap up today's celebration of these golden opportunities, remember that while we're excited about the potential, always do your own research and consider your risk tolerance. The mining sector can be volatile, even in good times.
That's right, Sarah. But what a time to be paying attention to this sector. These companies have transformed themselves, cleaned up their balance sheets, and now are reaping the rewards of years of disciplined capital allocation.
Happy celebration. Thanks for joining us on Golden Rush. Keep watching those charts, keep celebrating these incredible precious metals prices, and we'll see you next time for more golden insights.
Until next time, may your portfolios shine as bright as gold itself.